You've seen them, right? The headline's screaming, "This ETF will make you rich." You scroll past a Reddit post with screenshots of ridiculous gains, and that little voice in your head whispers, "Hey, that could be me." But what if that rush of excitement is actually a blaring warning sign? What if the very things being sold as a shortcut to wealth are really just a trap for investors who don't know any better? I'm talking about leveraged and thematic ETFs. They promise you the moon, but that promise has a dark side, a mathematical certainty that can absolutely destroy your portfolio if you don't know exactly what you're doing. And no, this isn't just another video telling you they're risky. We're going to uncover the 5 critical signs that you, specifically, might be the perfect target for these products. If any of these hit a little too close to home, you need to hear this before you invest a single dollar. Because the difference between using these tools and being used by them is figuring out if you're the right kind of investor. And for most people, the answer is a hard no. All right, the first and most critical sign you should run from these ETFs is if you're a long-term investor. You think in years, maybe even decades. Your plan is to buy something, hold on tight, and let it grow for retirement. Let's talk about Sarah. She's 35, a diligent saver, and she wants to speed up her journey to financial freedom. She stumbles upon a 3x leveraged S&P 500 ETF, and the idea sounds brilliant. Why settle for the market's 10% average when you could get 30%? So she invests a big chunk of her savings, dreaming of a retirement that's suddenly 10 years closer. Her plan is to just set it and forget it. And right there, she's made a catastrophic mistake. The very companies that issue these products repeatedly describe them as short-term, tactical tools. Many are literally designed to be held for a single day. The reason is a destructive little feature baked right into their DNA, daily rebalancing. To keep its 2x or 3x leverage, the fund has to readjust its bets every single day. If the market goes up, it has to buy more at the new, higher price. If the market goes down, it's forced to sell at the new, lower price. It's a built-in strategy of buying high and selling low, day after day. Over time, especially in a choppy market, this eats away at your money through a process called volatility decay, or beta slippage. It's a slow, insidious erosion of your capital. For instance, one analysis showed that over a 1-year period, a 3x leveraged S&P 500 ETF returned only 26%, while the underlying index gained nearly 15%. Not even close to 3 to 1 return you'd expect. The math simply grinds you down over time. Studies have even found that investors holding these for too long can lose money even when the index they are tracking goes up. So if you see yourself as a buy and hold investor, you need to know these are buy and erode products. They are completely incompatible with your strategy. Using a leveraged ETF for long-term goals is like trying to hammer a nail with a screwdriver. It's the wrong tool, and you're just going to make a huge mess. Sign number 2, you're not ready for these if you can't simply explain how it's possible to lose money when the market goes absolutely nowhere. If volatility decay just sounds like some fancy jargon you can ignore, you're basically walking into a minefield blindfolded. Let's use a simple, brutal example. An index starts at 100. On day 1, it drops 10% to 90. If you're holding a 3x leveraged ETF, you just took a painful 30% hit. The next day, the market has a great rebound, rallying 11.1% to get right back to 100. The index is flat, no harm done. But your 3x ETF, which goes up 33.3%, doesn't get you back to even. You're still down over 6% while the index is perfectly flat. Now, imagine that up and down pattern continues for a couple of months in a sideways market. The index could end up exactly where it started, but your leverage position might be down 50% or more. This isn't a fluke. It's just a math of compounding daily returns. Your losses are magnified, and the hole you have to dig out of gets deeper every single day. Volatility is the number 1 enemy of a leveraged ETF, and this is why. The appeal is that these funds use complex derivatives to give you that extra juice without needing a special margin account. But that complexity is a double-edged sword. You're paying sky-high expense ratios, often over 1%, for the privilege of having this daily rebalancing act slowly eat your lunch. So here's the test. If that example of losing money in a flat market doesn't make perfect sense, you have to stay away. Assuming 3x leverage means 3x returns over any period longer than 1 day is a mistake that has cost everyday investors billions. If you're finding this breakdown helpful and you want to keep learning how to avoid the hidden traps in the market, do me a favor and hit that subscribe button. We go deep on this stuff every week to make sure you stay protected. And definitely stick around to the end, because I'm going to share the simple, boring alternative that actually works for building wealth. All right, number 3. This one's for the trend chasers. The sign is that you're investing based on a story, not a strategy. You hear about the AI revolution, the future of genomics, or the metaverse, and you want a piece of the action. So you find a thematic ETF that bundles all the cool-sounding companies in that space. It feels like a smart, diversified way to bet on the future. Here's the problem. You're almost certainly late to the party. Thematic ETFs are usually launched after a trend has already had a massive run-up and the media hype is at a fever pitch. By the time a fund is packaged and sold to you, the high hopes are already priced into stocks, meaning you're often buying right at the top. Remember the flood of cannabis ETFs after the legalization hype in 2018? Many of them have dramatically underperformed the broader market ever since. We've seen the same story play out with themes like Web3, 3D printing, and others that saw a huge hype followed by a painful bust. By design, these funds are far less diversified than a boring old S&P 500 fund. They concentrate all your risk into one single, often speculative, idea. A theme like cybersecurity might sound like a sure thing, but if that one story falls out of favor with Wall Street, your whole investment goes down with it. The real danger here is survivorship bias. We only hear about the one fund that caught a trend perfectly. We ignore the graveyard of failed ETFs that were launched with just as much excitement. Research from firms like Morningstar has shown, again and again, that the vast majority of thematic funds fail to beat simple, broad market benchmarks over the long run. So if your reason for buying is AI is the future, that's not an investment thesis. It's a headline. You're not investing. You're speculating on a narrative. And narratives are a very expensive thing to buy in the stock market. This fourth sign is a little more subtle. You're a conservative investor. You don't like big swings in your portfolio, but you're frustrated with the low returns you're getting from safer things like bonds. Then you see a 2x leverage bond ETF, and you think you found a loophole, stock-like returns with the safety of bonds. This is a complete and total misunderstanding of what risk is. Leverage doesn't just make returns bigger. It makes the asset's personality bigger, especially its volatility. A 20% drop in the stock market is a pretty normal event, but if you're in a 2x leveraged stock fund, that's a 40% loss. Are you really, honestly, prepared to watch your money get cut by nearly half without panicking? Now let's apply that to a safe asset like gold. Gold's price can chop around sideways for long periods of time. For a physical bar of gold, that's fine. For a 2x leveraged gold ETF, that choppiness is fatal. Every zig and zag creates that volatility, decay we talked about, making the fund performance drift away from the actual price of gold. You can end up losing money even if the price of gold slowly goes up. Trying to use leverage to fix your own low-risk tolerance is a recipe for disaster. It won't make a safe asset feel safer. It will make it feel terrifying. The second that amplified volatility hits, your conservative instincts will scream at you to sell at the worst possible moment, locking in huge losses. You're not getting safe returns. You're taking on complex, hidden risks you don't even know exist. And the final sign, number 5, is that you're going without a crystal clear exit plan before you even click buy. You grab a leveraged or thematic ETF for a quick trade, or because it has momentum. You tell yourself you'll sell when it feels right or after it goes up a good amount. That isn't a strategy. It's gambling. As we've covered, leveraged ETFs are tools for disciplined, short-term traders. These are pros who have exact price targets, time limits, and stop losses set before they even think about entering a trade. They know precisely what will make them sell, whether it's for a profit or a loss. Most retail investors do the exact opposite. They buy, and if it goes up, they get greedy and hold on for a little more. If it goes down, they fall into the "I'll just hold it until it comes back" trap. which is a death sentence for a decaying product like a leveraged ETF. They turn a one-day trade into a multi-month disaster, just watching their account get bled dry by volatility decay. The same goes for thematic ETFs. The story that got you to buy will sound just as good on the way down. Without a firm reason to sell, you'll just ride the hype train all the way up and all the way back down again. Remember the boom in pet-related ETFs during the pandemic? The story was perfect. Everyone was adopting pets. But anyone who didn't have a plan to sell and take profits watched all those gains vanish. If you can't write down on a piece of paper, I will sell this ETF if X happens or on Y date, no matter what, then you have no business owning it. Without a plan, you are just a person providing the money for the disciplined traders to take. Look, if you saw yourself in any of these 5 signs, the long-term holder, the math avoider, the hype chaser, the safe leverage seeker, or the planless trader, then these products are not for you. They aren't evil. They're specialized tools for specialists. For everyone else, they're a wealth destruction machine. The good news is that the real path to building wealth is incredibly simple. It's not exciting. You won't get a brag on Reddit about a 100% gain in a month, but it works. It's owning a diversified portfolio of low-cost, broad-market index funds. It's buying a whole haystack instead of digging around for the needle. It's a strategy that requires patience, not genius. It's about harnessing the power of the entire global economy over decades, not trying to outsmart it day to day. Leverage and thematic ETF sell a fantasy that you can get rich quick without doing the work. The reality of successful investing is about getting rich slow, with discipline. It's boring, and that's precisely why it's so effective. Let the gamblers have their fun with volatility decay. You have a wealthier future to build.